Welcome students. We're going to be focusing on investment management. We're looking at equity asset valuation. This is support material 1's notes. We're going to be focusing on 3 different topics, looking specifically at investment management. Please remember that for investment management, you need a financial calculator. There's a recommended financial calculator here, which I definitely recommend purely because it's very easy to make use of. Remember, accounting and financial management, finance, all of it requires time value of money. So if you have a good financial calculator, you'll be able to do all the calculations quite easily. And the Casio FC100V is definitely one of the better calculators in terms of making use of the menu options and doing calculations on the actual calculator using the functions of the screen. So yeah, definitely recommend the Casio if you haven't purchased a financial calculator yet. Right, the scope for this particular module is looking at investment management. We're obviously going to be focusing on equipping you with the necessary knowledge and skills to perform investment analysis and portfolio management. So when you've gone through all the various units, you should have a much better understanding of the investment setting, details relating to portfolio management, understanding how decisions are made in relation to the organization, how we should be functioning as a business in the world. Obviously, decisions need to be made. When looking specifically at investment management, you're looking at some sort of return on investment. We'll also look at developments in investment theory. We'll look at time value of money. We'll focus on different valuation principles and concepts relating to bond valuation, equity valuation, and then obviously portfolio analysis. We'll be looking at the different steps covered in terms of fundamental analysis. We'll be looking at company valuation, technical analysis, and then fixed interest securities and derivatives, and then finally focusing on portfolio management and a little note about foreign exchange. Okay, so let's begin. We're looking at topic number 1, which is focusing specifically on the investment background. When looking at investment management, we need to consider what the focus is in terms of our goal. What are we trying to achieve? All right, so when we're looking at study unit 1, which is focusing on the investment setting, I want you to think about what does investment management mean to you? Take a minute to think about that question. Maybe even pause the video here and try to answer that question on your own. When you're looking specifically at investment management, what are you thinking about? What comes to mind? All right, we'll have a look at this picture, this image. All right. When looking at finance, money, obviously you're going to be receiving a certain amount of money, maybe from the work that you do, or maybe you have some sort of business that generates income, or maybe you even receive capital from someone, and you're required to manage that money. The big question is, what do you do? So when looking at investment management, the word investment is focusing on long-term growth or return on investment. Okay, so we know money is difficult to get hold of, and if you do get hold of money, either through the work that you do, maybe a business raising capital, whatever you do, once you've received a certain amount of finance or money, you then need to manage that responsibly. And if we're looking at investment management, that's exactly what you're looking at. You're looking at taking those limited resources that you have, investing them towards something. So it could be a business, an asset, whatever it is. But you're trying to make a decision on where you could allocate those funds in order to generate the best possible return on investment. So when looking specifically at investment management, you're looking at keeping track of all those income producing assets, making sure that those investments that you've made are going to pay off over the longer term, and making sure that you select or choose investments correctly. So when looking at the investment setting, the first thing we need to obviously understand is what is investment management. So Always remember, just think about resources, funds that you have available, money that you've got, and where are you going to be allocating that money? Where are you going to be placing it in terms of investments? And are you going to be generating the best return on investment? The next thing we need to consider is, what do we want to achieve? Or what is the goal? That's also very important, because when looking at investment management, there's going to be a lot of decisions that need to be made. And those decisions have to be in line with your goals. So if you're looking at something like personal financial planning, obviously every individual is different. Every individual has different goals. All individuals, and every individual has different needs and wants. So if we're looking at what do we want to achieve, that would be something like the target or the goal or the benchmark that we're trying to meet in terms of our investment. We want to invest money where we're going to be generating the best possible return. And if we have a goal, we need to achieve that goal through that investment. So if we're looking at the investment itself, here we're focusing on different assets. Remember, when looking at accounting, you've probably seen this word asset before. An asset is going to be generating some sort of future economic benefit, or you could refer to that as income. Right, so assets can be income producing or income generating. Those are the best assets to have, because those assets are going to be creating wealth. They're going to be generating income. Think about renting a house. As the landlord, obviously. Okay, if you're renting, you're paying the landlord. So if you're the landlord and you have that property, that would be seen as an asset, that would be seen as investment. Or think about a shareholder owning shares and getting paid out dividends every year or every half year, okay, twice a year. Right, so when you're looking specifically at an investment, think about assets, think about anything that can generate some sort of return in the form of income. All right, so we're producing income, we're creating benefit, we need to invest, we need to create a business or a project, or we need to invest in land, okay, and buildings in order to generate some sort of return. Right, so the final question is, if you had to win, let's say, a huge amount of money, if you won 100 million rand, what would you do with it? You've probably heard of some of those horror stories where people win the lotto or they win some sort of jackpot, and within a few years they literally go broke. How is that possible? Well, it all comes down to investment management. In other words, the decisions that we make as individuals, okay, as investment managers. If you had to win 100 million and you were focusing on that as capital that's going to be used in terms of a fund, and you're going to be the investment manager, and you're going to manage this investment of 100 million, where are you going to invest that money? What decisions are you going to be making? And that's something that you always need to consider when looking at this particular module, okay, investment management. Right, your ability to make the right decision is important. Right, remember, there will never be a perfect decision. There will only be a right decision or a best decision in terms of suit or fit. Right, so based on everyone's goals, based on what they want to achieve, you're then going to be choosing the best options for that individual. Where should they invest their money? How much property should they own? How much equity should they have? Should you consider cash or bonds? All right, so those are other considerations that we need to look at. Just remember that if you are an investment manager, you have a certain amount of capital, money, which you have in your funds or your fund, and you're going to have to allocate or invest that money in order to receive some sort of return on investment. Okay, so study unit 1 is looking at this concept of committing money or other resources with the expectation of reaping some sort of benefit in the future. Right, so think about what we have initially. Okay, money is needed. Okay, we're going to be saving and investing. Okay, saving is short-term investing. Investing is long-term. So taking a 3, a 5, a 10-year time frame, or even longer than that. So when we're looking at this concept of the investment, we obviously need to generate some sort of return. And that's what we're trying to create. We're trying to create a return on investment. In other words, can that money grow? Can we get more money in the future? So when we're looking at investment management and we're looking at the investment setting, there are different asset classes that you could consider. Obviously, stocks, okay, or shares, Johannesburg Stock Exchange. Okay, that would be equity. Right? There are many, many different forms of investment out there. Okay, remember, any asset will be seen as an investment because this asset can either increase in terms of appreciation, so the value of that asset can increase, or that asset can generate income. So it can be an income producing asset, or it could be both. It could be producing income and also appreciating over a period of time. For example, property. Whether it's commercial or residential, it doesn't matter. Okay, but property, land and buildings, that would definitely be seen as a form of asset class. Right, so you've got property, you've got equity, and then you've got commodities, so gold. You've also got foreign exchange, okay, currencies, and alternative asset classes such as artwork, paintings, sculpture, etc. All right, so when we're looking specifically at an asset class is just looking at category or a grouping of similar assets that we can make use of, that we can purchase, that can generate some sort of investment return over the longer period of time. All right, so for example, paintings. If you had purchased the Mona Lisa, obviously that painting is world famous, and the likelihood of it being worth more in the future than it is worth today is quite likely because there's only one painting like it in the world, and obviously the artist or the painter has since passed away. So there's a limited amount of paintings that are out there in the market. So when we look at asset classes, we're looking at these markets. We're looking at the property market. We're looking at the commodities market. We're looking at the stock exchange market. Right? So a market is where all these buyers and sellers meet. Right, so something for you to think about, a discussion question. Which asset class do you think is best to invest in? And you might have your own personal preferences. So when you're thinking about investments, when you're thinking about assets, some of you like property, some of you like equity, some of you like commodities, some of you like paintings and alternative asset classes. It all comes down to what do you feel most comfortable investing in. Remember, the world will always present certain opportunities, and those opportunities can either help you or harm you over the longer period of time. So when we look at asset classes, you will have your own personal preference. And what we talk about here is asset allocation. All right, so remember, we spoke about investment management as a course or a subject that involves taking resources, money specifically, allocating that money to certain areas or purchasing certain assets in order to generate or receive a certain return on investment in the future. So if we're focusing specifically on asset allocation, we're looking at how much equity am I going to purchase? And this is something that you can see on a unit trust fund. That's quite a very simple, easy example where you can see the breakdown of all the assets. So in a unit trust, they might even show you a pie graph, something like this. And they might say, well, approximately 50% of the fund is invested in property. Maybe you have a portion that's invested offshore, so in other countries. A portion could be invested in equity, and maybe a portion invested in bonds or cash. All right, so again, asset allocation is looking at your ability to take money and purchase various assets with the hope of generating a return in the future. The next concept we have to look at in detail is this concept of risk. let's think about that word risk. What comes to mind? Are you thinking about something good or are you thinking about something bad? Most people are probably going to be thinking about something bad. But the problem with that is risk doesn't have a good or bad connotation attached to it. Risk can be good or bad depending on what the outcomes are going to be. Right? You could take maybe a very, very bad risk but have a very, very good outcome. Or you could take a very, very good risk perhaps and you could land up with a very, very bad outcome. It all depends. But the point I'm trying to make is risk is uncertainty. No one knows what's going to happen. The consequences could be good or bad. So if it's a good, we'll have a positive return on investment. If it's bad, we'll make a loss. Right? There will be a negative return on investment. What we need to do as the investment manager is we need to manage the risk and we need to make sure that we maximize the returns. So there is a risk versus return relationship which looks at assets and how those assets can be managed in terms of decision making so that we can achieve the best possible return on investment based on these different levels of risk. Right, so if we're looking at managing risk, we need to think about statistics. In statistics, you have something called an average. Okay, this average could be the mean, okay, the middle point. And then you obviously have a deviation, okay, from the average, okay, what's expected. Right, sometimes the deviation could be negative, sometimes the deviation could be positive. So if we look at investment management, this average is sometimes called the benchmark. Right, so if we look at all the funds out there, if we look at all the stock exchange companies or the top 40 stock exchange companies, or we could look at the resource indice, okay, the financial indice. Okay, in other words, we're looking at some sort of index that is giving us indication of how well that specific benchmark or industry is doing. Okay, whether it's financials, resources, the top 40 index, whatever it is. So these different indices give us some sort of measurement that we can benchmark our returns on in terms of what we expect. It could be less than or better than what we expect. So when looking at risk, the measurement all of you are going to be using in this course is standard deviation, which is the most common statistical measure, stats. For risk, you've got beta, which is looking at market risk, another measure. It's a statistical measure of risk. And then volatility can also be measured. In other words, how volatile is the market? Is the market like this, crazy, or is the market like this? Okay, more predictable, okay, in terms of volatility. So volatility is we have these massive swings up and down, but constant. All right, so it cannot be tracked very easily, or your level of prediction or estimation is affected by the volatility. But all of this can be measured. Standard deviation, beta, volatility. So different types of risks that you could get. Political risk, liquidity risk, currency risk, geographical risk, credit risk. There's so many different types of risks out there. Foreign exchange risk, unemployment risk. Okay, we're looking at recession risk. Any risk could be categorized in different categories. Any risk could be identified, which is uncertainty. We don't know what's going to happen. And if we don't know what's going to happen, we don't know what the consequences are going to be on our business if something like that should happen. Right? So businesses need to manage these risks. Currencies can fluctuate up and down, up and down. Politics, okay, the political landscape can change, and that can create unrest or uncertainty. Liquidity, are you able to buy and sell your assets very easily, or does it take a lot of time and effort? And then obviously other considerations, maybe like climate, right? The geographical location. That's something that you could consider in terms of a risk, right? These risks can obviously affect your investment. Are we going to invest in a particular country? Are we going to invest in a particular location? And then you get more common risks such as credit risk, looking at borrowing or lending, and what sort of risks are attached to that in terms of default or bankruptcy. Right, so all of this falls under this category of risk. When looking at investment management, there are different ways to mitigate or reduce the impact of risk on your portfolio. So if we're looking at investing in different asset classes, we spoke about asset allocation. There's a concept called diversification, and that concept speaks to this picture. Don't put all your eggs in one basket. Some of your money should be invested in the stock market. Some of your money should be invested in property. Some of your money should be liquid in the form of cash, instant access. Right, cash or bonds. Right, those would be lower risk investment type vehicles that are more conservative in nature. The returns don't fluctuate as much. When we look at diversification, in order to manage the risk, we need to make sure that we diversify. Right, so keep your investments balanced, a portion in all these different asset classes. And sometimes you might want to rebalance the portfolio. You might want to invest more in property during certain cycles of the market. Maybe there's a property boom and you want to be more heavily invested, or you want to be more overweight property, okay, and underweight maybe equity, depending on your portfolio mandate. Okay, in other words, how much can you potentially invest in these different asset classes? Some funds have certain mandates, right? You could have a property fund, you could have an equity fund, you could have a diversified balanced fund, right? Those funds are going to be investing in lots of different assets, and we always need to consider the time horizon, because risk is a concern, but over the short term, risk can be very, very volatile. We don't know what's going to happen. But over the longer term, okay, even with all that volatility, over a long period of time, things can still be looking up or looking better. But over the short period, things can look very volatile, right? Maybe because of recession, all right, certain bad things happening in the economy, and that can create very, very big moves in the market that can affect your decision making in terms of risk. Certain times are considered more risky than others. All right, a concept that we need to be familiar with is this idea of inflation, which actually relates to economics. When we look at economics, inflation is discussed as the increasing of prices over a period of time. So if you're thinking about the price of fuel 5 years ago versus today, the price is drastically different. The price is obviously a lot higher now than it has ever been in the past, purely because of unrest in the world regarding conflict. So we've got the war in Ukraine. We've got different suppliers of oil controlling the supply of oil, and that can affect the price of oil and ultimately fuel. So if we're looking at this concept of inflation, just remember that assets or prices of certain assets, or even expenses, I mean fuel, you'd be using fuel maybe to power certain generators. If we think about like power creation or load shedding and how generators can be used to generate electricity, or fuel can be used for vehicles, for transportation and travel. Right, so the point is that when looking at inflation, you need to remember that the price of assets or the price of different expenses, whether they're assets or expenses, it doesn't matter, but the prices of different things generally increase over a period of time. They can decrease as well. It all depends on what's happening in the actual economy. And then we have another note about what do you think the current price is. All right, so if you had to do some research, go search online and see what is the current price of fuel and what was the price of fuel a few years ago. And then have a look at the discrepancy. Have a look at how things have changed. The world today is obviously dealing with high levels of inflation. If any of you are watching the news or following the news, you'll hear about inflation across the world, different countries managing inflation going up, the prices of goods and services becoming very expensive and unaffordable in some instances. So just remember that inflation is something we need to consider in investment management, because if we're investing, we want to obviously offset these negative effects of inflation. So in other words, we want our investments to grow at a rate higher than inflation, because that will protect the buying power of the money that we have invested. Right, so if you're investing money, you obviously want to be able to do more with that money in the future. And in order to do that, you need to keep up with inflation. So inflation is something that can definitely affect the general standard of living for everyone in the world. Inflation, we know, is the general increase in prices over a period of time, and that can relate to assets or expenses, anything. Inflation definitely eats away at the buying power of money. So if we're looking specifically at inflation, as an investment manager, we need to remember that there's a constant battle between the investment manager and this concept called inflation. We need to make sure that our returns, the returns that we get on our investment, are either in line with inflation or better than inflation, because we want our money to grow. We don't want the buying power of our money to diminish over a period of time. So just remember, inflation is a very, very important economic concept that relates to investment management as well. So in different questions, you could be asked different questions relating to inflation and how that affects your rates of return. So when you're looking at these nominal rates of return, or when you're looking at real rates of return, we always need to take inflation into consideration. So when you're looking at nominal is the big rate, okay, the nominal rate before inflation. This nominal rate is going to provide for inflation, okay, and obviously what you have left would be the real return on investment. So this is coming from the Fisher equation, where you have a relationship between nominal and real. And this can be analyzed in the market. You could go back in history and time. And if you go back in time, you can obviously see certain discrepancies in terms of the return on investment that you would be generating if you were, let's say, saving money in the bank and generating interest, and then having to pay for certain goods and services. If inflation is a problem, if inflation is too high, that's going to obviously affect the amount of real returns you're going to be receiving. So that's something that you always need to consider when looking at investment management. Something we need to calculate is the nominal versus the real rates. When looking at the equation, you've got 1 plus nominal equals 1 plus real times 1 plus inflation. So if you were given a question like this, if you had the expected inflation rate as 6.5% and the nominal risk-free return is 8.5%, is it possible to calculate the real risk-free rates of return? Well, definitely. You would have to plug in or substitute all those values into the formula. So if I'm looking specifically at the nominal, 8.5%, that's going to be invested. And then inflation is going to affect that investment. I need to substitute all those values in, the nominal rate and the inflation rate. And then it's possible to calculate the unknown, which is the real rate of inflation. And if you do that calculation, you're going to have to apply some mathematics, some general arithmetic. And if you follow all the steps on screen to solve for the real rate of return, you'll see this real rate of return, okay, is 1.877%. That's the actual rate of return, right? Because in this scenario, your nominal risk-free return is 8.5 and your inflation rate is 6.5. And that's why we talk about this whole idea of inflation eating away at the buying power of money, right? Inflation will affect the buying power of money because you're going to be reducing that real rate of return. So you have real return. The real return is basically an indication or a measurable, a quantifiable amount that you have identified as being what return you actually have, taking inflation into consideration. So again, if you had to go look at these different investment funds, unit trust, whatever it is, they would always disclose information in line with inflation. Inflation is one of our worst enemies. We spoke about how inflation is going to destroy the buying power that we have. So if we are investing our money, we obviously want the biggest return on investment. So if we're looking at this example, if we had to round off, obviously the real rate of return is only 1.88%, round off to 2 decimal points. All right, then we have a whole lot of slides here that will help you better understand how to calculate the different measures of risk using statistics. So when we look at statistical measures, remember, statistics is a way to monitor and manage data that we've collected from past performance. So the first calculations that we need to look at relate to these concepts. We've got an expected return that we need to calculate, variance, something we need to calculate, standard deviation, right? There's a formula for this, and there's a table that we can use to calculate that. And then we also need to plug that into an equation which will determine the coefficient of variation. So only these are different measures that an investment manager would want to calculate in order to manage the investments appropriately. So let's have a look at all these different equations. If we had to break up these equations into words, the expected return is just the sum of all of the possible returns times the probability of those returns. And that'll obviously be given in some sort of table, which we'll look at in an example. The variance, in terms of its formula, if we had to write that down in words, would be the sum of all the probability of return multiplied by the difference. When I take the return and I subtract my expected return, and if I square that, what does that give me in terms of variance, right? Because variance is a measure of variability. Okay, variance is actually standard deviation squared. Okay, and if you're looking for standard deviation, well then you could square root the actual variance in order to determine what that amount actually is. So just remember, standard deviation is that deviation from that expected value. Okay, and that's why you have a return. Okay, you're trying to identify what is the return and is it in line with the expectation. If it is in line with the expectation, or if it's better than expected, then that would be favorable in terms of growth or investment. Okay, you want your investments to grow. Right, then you have a formula for the coefficient of variation, which is just looking at a relationship between your standard deviation and your expected return. If I take standard deviation and I divide that by my expected return, that's going to give me my coefficient of variation. Right, so do I need all these fancy equations? Well, the answer is no, you don't. There is a table method that can be applied, and this is a really simple way of remembering all these long equations. I don't know if you're going to be assessed open book. In other words, will you have your notes and your formulas with you when you're writing your final assessment, or will it be a closed book assessment that you'll have to be writing in some sort of exam venue under invigilation? So if I'm looking at a table method, this is just a nice method that can help me calculate coefficient of variation, variance, and standard deviation without having to remember all these equations. Right, so let's see how we actually use this table method. It's a very simple way of remembering very long equations. All you have to do is just draw the right table and then follow all the steps. Right, you have 8 steps in total. We're going to go through each of these steps to show you how to calculate the different measures. Okay, the standard deviation, the variance, as well as the coefficient of variation. Right, so when we're looking specifically at the table method, you have to draw the table first, and that comes from the information in the question. So in this example, you've got 4 different situations. You've got situation A, B, C, and D. And then you have all of these different returns. That would be the return, and this is the probability. Right, so we know from before, when we're looking at variation or standard deviation or variance, whatever it is, obviously we're going to be focusing specifically on mathematics. We're going to be applying statistics. Right, so if I'm looking at the expected return, the variance, the standard deviation, and the coefficient of variation, I need to go through this entire process. Right, so the first thing we need to do is draw up the table, right, and take all those values from the question, all the possible returns, and insert them on the table. Okay, so I've written them down and I've used decimals just because it's more accurate and you don't have to worry about doing any sort of conversion. Right, so I've literally converted everything to a decimal, so all the answers that we do get will already automatically be in decimal format. Right, so when looking at the table, the next step is to calculate the expected return using the expected return calculation column. Right, so how do I get all of these values? Well, we need to take the possible return and we need to multiply that by the probability. If you're multiplying the possible return by the probability, that's going to give you an expected return. If you add up all of these amounts, that's going to give you the expected return, which is a decimal, and you can convert that back to a percentage by multiplying it by 100, so 7.25%. Right, but because we're doing calculations using decimals, we're going to leave it as is. Right, the next part is then to use this expected return, okay, insert that expected return into the column for expected return, and then calculate this deviation from expected. So now we have this expected return. We know the expected return is the 7.25%. We know that there's going to be some sort of deviation from the return. Okay, these are possible returns. Right, so if I'm looking at possible return number 1, okay, and the deviation from the expected return, so I'm going to subtract, okay, so negative 0.1 minus 0.075 is going to give you negative 0.1725. Right, so you're basically taking this column and you're subtracting that column to get this column. Right, same thing here. 0 minus this amount is minus 0.0725. Okay, 0.1 minus this amount is going to give you that answer. 0.25 minus this amount is going to give you that answer. And once you've done that, you're going to have this deviation from expected value. Right, in the next step, you're going to be squaring the deviation. So when I say squaring, okay, multiplying it by itself, right, deviation squared. Once I've done that, I'm going to get all of these values. And then the final step is to take your squared deviation column, which is this one. There's the column, and you need to multiply that by the probability. So those two columns are being multiplied in order to get the final column here, which is your squared deviation times probability. Right, once you've done that, you're going to have to add up all of these, total that up. If you total that up, that's the sum. Okay, you're adding up everything, you're totaling. If you add up all of those amounts, you're going to get that, and that represents the variance. Okay, once you've got the variance, you know standard deviation is square root of the variance. Okay, you know that. All right, so that's something that you can type into your calculator to get the right answer. All right, if we do the typing into your calculator, you're going to get standard deviation amounting to that. All right, 12.79% if we round it off to 2 decimal places, okay, as a percentage, not as a decimal. Okay, you can round it off. That'll be 12.79% per annum as a return on investment, but deviation rather, I should say, as a return on investment. And the last step is just the coefficient of variation, which we saw that earlier. It's a formula, right? We need to put standard deviation into the equation and divide that by your average, your return, okay, your expected return. Right, is it possible to do this using mathematics and statistics? Okay, equations. There's the equation. It looks very complicated, not as easy to interpret as a table. Right? So tables are definitely useful. They're useful for helping you to keep track of different calculations. right? You'll get the same answers. Expected return, we saw that earlier. Your variance, okay, it's just being rounded off, and then obviously standard deviation would be the square root. Right, so just remember, when you're looking at the table method, always remember to use decimals. Okay, decimals will definitely help you. Convert the percentages to decimals and then do the working. All right, let's have a look at other formulas that you need. The next is the covariance. The covariance is a measure of the degree to which returns on two risky assets move in tandem. Right, so a positive correlation means they move together. A negative correlation means they move inversely or opposite. Right, so correlation and covariance, they're both very, very similar. Right, if we're looking at covariance, we're looking at two different measures moving together in tandem. Correlation is we're looking at two separate observations, and we're looking at, is there a correlation between the two? And if we have perfect positive correlation, then we'll have 1. If we have perfect negative correlation, then we would have -1. But in most instances, you're going to have somewhere in between, right, in terms of positive and negative correlation. And that would be a correlation where you have 0. Okay, there's no correlation. It's completely random. Right, so how would you calculate this? Again, formulas. Right, there's the equation for covariance. I've just tried to write that in words so you can interpret what's happening. You're going to sum up all of the probability times the return minus the expected return, and you'll multiply that by the return, okay, minus the expected return. So you're taking different amounts and you're analyzing those amounts separately to identify if there's some sort of covariance, okay, between maybe two different assets, okay, covariance for A and covariance for B. Right, you're looking at both. Correlation is quite simple. Correlation is just the covariance, which is something that you would have calculated previously, and then you would divide that by open brackets. Okay, your denominator needs to be multiplied beforehand as a separate calculation before you do the division. So just remember that the brackets are there for a reason. Right, so take your covariance and divide that by your standard deviation for A times the standard deviation for B. And if you get -1 or +1, you've got this concept of like perfect correlation. Right? It's never ever going to be perfect, but you could be quite close. You could be positively correlated or negatively correlated to certain assets, depending on what you're analyzing. Right, so here's an example. Given the following probability distribution, you've got probability for share A and for share B, and we're determining what the covariance is between these two shares, A and B. So in order to answer that question, we're going to need to create the table. Right, so we've looked at these tables earlier. I'm just going to ask you to maybe try do them on your own, see if you'd be able to draw up these tables and do these calculations in order to get the different returns that we need. All right, so remember, possible return times probability is going to give you expected return after you've added up the two together. Right, so 0.5 plus 0.5 gives you 2 as the expected return. And for this one, you've only got 0.05. Okay, so 0.2, if you multiply that by 100, you get 20%. If you multiply this by 100, you get 5%. Right, so looking at the expected return for each share, you can see that you've got A, 20, and you've got B, 5. Right, our problem in this question is, can we determine or calculate the actual covariance? Right, so remember, covariance was the sum of all the probability multiplied by the return less the expected return for A. And then you've got B's return, okay, multiplied by the expected return for B. So if you take all those values that we saw on the previous slide and we substitute those in using that amount that we calculated, you're going to get the same answers there. Right, covariance in this question works out to 0.015. So if you times it by 100, you would get 1.5%. Okay, we have to change focus slightly. We're going to be moving away from some statistics, and we're going to be focusing more now on the concept of measuring a return. Okay, we spoke about returns earlier. Remember, a return is looking at having invested something today, T0, and then at some point in time in the future, maybe at year 5, okay, how much is that investment worth? And can I work out a return that's going to represent how much money was earned over that period of time? In order to do that, you need a few equations. So there are many different equations that can determine or calculate what yield is. When we're looking specifically at this course, you are required to calculate the holding period return, the holding period yield, using these equations. Right? So make sure you're able to calculate all of these different returns from an investment manager's point of view. Right, so we spoke about this timeline. We've got a start and a finish date. Obviously, the moment you have started to invest, if you've invested something today, that would be the start. And then you would track the holding period return. How well is this investment doing each day or each month or each week, depending how frequently or often you're checking that information. Right, so when you're looking specifically at the holding period return, you're looking specifically at the amount of money that's generated from having invested to the end, okay, when the investment matures. Right, so just think about the holding period return as being the actual real value that's generated over the investment period, taking everything into consideration. Right, so there's an example for you all to try. Here we have example 1, which is looking at the 1st of Jan. If you bought 50 shares at 200 Rand, 120 Rand per share, and a year later you sold them for 150, what would the holding period return be? Right, so obviously you bought 50 shares. Okay, they also tell you that you received dividends of 3 Rand per share. So if we use those equations, okay, if we calculate the holding period return, you're going to get 1.275. Okay, the holding period return, remember, is a ratio, right, a calculation. How much income or benefit do you receive from that underlying cost that you have incurred? And then if you're looking at a yield would be a percentage. All right, so that's quite an easy one, right, as a percentage, looking for the right answer, okay, where we've got an amount that is going to be removed or taken out. All right, we've finally reached study unit 2, which is looking at the organization and functioning of the securities markets. Remember, investment management is looking at investing in different assets. Okay, if we're looking at the securities market, we're looking at the JSE, okay, the stock market. Right, so there are different markets here. You get a primary market and a secondary market. A primary market is where you have an IPO, an initial public offering. Right, new market, okay, that issues new securities on an exchange. The secondary market is where you have existing securities that can be bought and sold on an exchange. Right, so a market where these investors can purchase securities or assets from other investors rather than from issuing companies themselves. Right, so an IPO, obviously there'll be an investment bank there. That investment bank would help assist a company to list on a JSE, okay, or on a New York Stock Exchange, whatever the exchange is. Okay, when you're starting a business, when you have you've created a private company, and at some point in time you want to list your private company on an exchange, in other words, make it go public, the primary market is that IPO. The secondary market would be where everyone can buy and sell those issued securities. Right, so you've got primary market, secondary market. Okay, with the secondary market, obviously you have a regulated stock exchange, and then you have the free market, okay, where anyone could be buying and selling those shares. Right, nowadays things are very heavily regulated, so an exchange would be the best place to purchase any of these financial instruments, because you want the peace of mind that you have regulation in place to make sure that you haven't purchased any assets that aren't real. I've just given you some pictures or images here of some of the biggest stock exchanges in the world. Okay, London Stock Exchange, Tokyo, and as well as America. Okay, so New York Stock Exchange, and then you've obviously got South Africa, which is the JSE, which is based in Sandton, right? Johannesburg Stock Exchange, right? In all of these markets, you'd be buying and selling these different assets. Okay, you can buy bonds, you can buy stocks, you can buy any publicly traded security. Right, so just a bit more information regarding these two different types of markets, the primary and the secondary markets. Remember, we spoke about well-functioning markets. You want markets that have credibility. In other words, news, information, right? Accurate information relates to the price. So if I'm buying certain shares in the market, let's assume I'm going to be investing in a large public company, something like Naspers, for example, one of South Africa's biggest companies. If I had to invest in Naspers, right, how much am I going to pay? What is the price that I'm going to have to pay for one share in that public company? If I'm looking at a well-functioning market, well, then you want access to a market where everybody can have access to that same information. So that information is fair. That information is rapidly disseminated. In other words, the entire market has access to the same information. There's no inside trading or information that is not publicly available. Another thing to consider is how liquid is the market. If I wanted to sell my shares in Naspers today, would I be able to do it? What sort of liquidity do I have for those particular assets? And then obviously costs are important. Okay, in investment management, when looking at buying and selling these different assets, you want to make sure that you're not incurring unnecessary amounts of costs, okay, fees. You don't want to spend a huge amount of the investment on fees or commission or charges that these different institutions require you to pay as the investor. Right, we'll touch on trading in more detail in a later chapter when you're looking at more technical analysis. For now, the textbook in Study Unit 2 is just going to highlight a little bit of background regarding these different terms that you'll see in the market. If you've followed any good news report or if you watched any good news program, whether it's on television or radio, you will often hear these terms, a bull market or a bear market. Right, in a bull market, the market is increasing in value. Okay, the market is rising. Okay, it's a bull market. The bulls are running. Okay, it's a bull market. Prices are going up. In a bear market, prices are going down. All right, prices are decreasing. Okay, same thing with these words long and short or buy and sell. If you're looking at a short, okay, a short refers to a sell. Okay, you're taking a certain position in the market. If you're taking a long position in the market, you're looking at buying into the market. Okay, so these are terms: bulls, bear, and long. Sorry, I said bulls, bears. Bulls buy and long, bears sell and short. Okay, those words are linked in terms of the market and trading industry, the trading industry. And then you've got different orders that you can place. Now, this is very technical. Obviously, if you are buying and selling certain shares, there will be different orders that you can place in the market. A market order, a limit order, or a stop loss. Right, more on this at a later stage when looking at technical analysis. Right, when looking at trading, you can buy and sell almost anything. The markets have become very sophisticated. You have a whole host of different assets that you can purchase. You can buy stocks or shares. You can buy bonds, you can buy treasurables, currencies, indices, EFTs, commodities, options, futures, and many, many other derivatives. All right, so there are many, many different financial products out there in the market that you can potentially buy or sell. Just remember that some of these financial instruments can be very, very complicated and very sophisticated. So make sure you do your homework, make sure you know what you're buying, and make sure you know what you're selling before you make a purchase. And then the last section is looking at these developments in investment theory. Here we're focusing specifically on different measures. So the one being CAPM, the capital asset pricing model. We'll be looking at that now when we're talking about this whole idea of asset valuation. Okay, when we look at asset valuation, remember the big consideration is how much is something worth? What is the fair price that I should pay for an item? And is that price under or overvalued? Right? If I have something that's undervalued, well, then that would be a good opportunity to buy. Okay, you would want to buy assets that are undervalued because those assets are actually worth more, but you can buy them at a lower price. If the market is overvalued or if the prices are overvalued, well, then that could potentially be a good place to sell. Right? You'd want to sell assets when they are overvalued, when you can get a very, very high price for those assets. So when we're looking specifically at asset valuation, there's this whole idea of yield. Okay, you're constantly on a quest for yield. You constantly want to generate more return. You need to evaluate the risk, though, that's going to be present in each of those different assets that you're going to be investing in. So when looking at asset valuation, are all investments considered equal? Well, the answer is definitely not. Right, if you're investing in equity or shares, those are very, very different investments compared to property or bonds. If we're looking specifically at risk-free, is there any sort of risk-free return? Well, the answer is yes, there is. Okay, we will talk about cash. Okay, cash, inverted commas, is considered risk-free. If I hold money in the bank, that cash is going to be generating interest. That could be considered a risk-free return. Right, that money that I have in the bank is not going to go anywhere. Right, banks are generally very heavily regulated, and banks generally don't go bankrupt. Okay, they can, and there are unique instances where that has happened because of greed and other derivative products in that market. For example, in 2008, when Lehman Brothers had crashed, that was due to greed and the mortgage subprime products that basically went to zero. Okay, they weren't worth anything. They were worthless. And that can happen where assets can be valuated very high, and then those prices can fall very quickly. And if that does happen, those asset values can decrease. All right, so just remember that if we're looking at a risk-free return, we're looking at some sort of asset that doesn't carry any risk, and that's generally considered cash. And then the last question is just to consider what return would you expect for risk? And that's a very subjective question because you could be a very high risk investor, you could be very aggressive, or you could be very conservative. You don't like taking very, very big risks. So if you look at asset valuation, we need to look at some sort of model that's going to help us to measure this relationship between risk and return. Right, so we call this the capital asset pricing model. The capital market line demonstrates this linear function, right? And it looks very simple. You've got return and you've got risk. And obviously the relationship is upward sloping, right? So if I take on more risk, I would expect a much higher return. If I take on less risk, I would expect a much lower return, right? So that's just the market principle in terms of the capital market line. Remember, we look at investment management, right? So if you are going to be taking on more risk, if you're taking on more risk, you want to make sure that you're generating more return, right? You don't want to take on more risk and have less return. That wouldn't make any sense. So when we're looking at investment management, you're looking at maximizing your return at a particular level of risk. And we can measure that, and we can look at this linear relationship in more detail in the actual capital asset pricing model. Okay, so if we take that basic relationship further, there is a formula that describes this capital asset pricing model, okay, where you're calculating the required rate of return on a particular asset. Right, so for example, if you look at that securities market line, we spoke about it, okay, the relationship between risk and return. Okay, you've got return here, and then you've got risk here. Right, the only difference is when you look at CAPM, okay, CAPM, capital asset pricing model, we're looking at beta as the measure of risk, and then we're looking at your expected return as a measure, okay, taking risk-free into consideration, okay, your risk-free return. Right, obviously, there's going to be some sort of premium that's going to be applicable if we're looking at the difference between what the market will provide okay, and the risk-free. All right, so when we're looking at market risk, we're looking at beta. Okay, so 1 being the measure in terms of beta for market risk. Right, if there is zero market risk, in other words, zero beta, if we're not invested in the market, we would assume that is risk-free. Okay, so a risk-free return would generate, okay, a certain amount. Okay, that would be the cash rate. Okay, so if I leave money in the bank, okay, how much return or how much interest am I going to get on that money? That would be considered risk-free. As soon as I start taking on risk, I'm going to want a higher return. Okay, and this is what we're looking at in the capital asset pricing model. You're looking at a measurable required rate of return for a particular asset based on its level of risk. So how do we do the calculation? So here's the equation. Okay, remember we spoke about this linear relationship between the required rate of return from an asset and we're looking at the beta, okay, the measurable amount of risk that we can look at. Also taking the risk-free rate into consideration. Right, so when we look at the capital asset pricing model, the required rate of return is calculated by incorporating the risk-free rate, but then adding this market risk premium. Okay, remember that differential between what we have, okay, with zero risk, and if we do increase the amount of risk, what is that additional benefit that we would expect to receive in order to justify taking that risk? So the formula is quite basic. Okay, you've got these different symbols representing the required return. Okay, that's the required return. RR, required return, all right, is the risk-free rate of return, okay, plus this market risk premium. Okay, this market risk premium is calculated using statistics. Okay, you've got B representing beta or beta. Then you've got the market return, what the market is going to generate, minus the risk-free. Okay, the risk-free return. Right, we saw that earlier in this diagram. Okay, this is that premium. Okay, that premium that you have in terms of if I take on more risk, I want a bigger return. Right, so we're looking at basic straight line. Okay, obviously straight line. Right, you've got a y-intercept here, and then you've got points along the line. Right, so we're looking at those points along the line. Right, so this formula is a straight line. Okay, this is basically like your c-intercept. Okay, and this is your mx, okay, your gradient or your slope. Okay, so mx plus c. Right, so your c is obviously risk-free because that's your y-intercept. All right, and then you've got beta, which is another measure which can also be calculated. If you're looking at beta, what is beta? Beta is just the sensitivity of a security's returns to the systematic or market risk factor. So in other words, it's the responsiveness of a security to these different macroeconomic events. And remember, beta is the measure of risk in the market. Can you calculate beta? Definitely. To calculate beta, you need the covariance of the asset and the market, and you need to divide that by the variance of the market. So if I give you an example that says that the market variance is 0.15 and the covariance of the company A and the market is 0.5, well, in order to calculate beta, I'm going to have to take the covariance of the asset and the market and divide that by the variance of the market. And that's going to give me a measure of beta. Remember, beta is a measure of risk. Okay, beta is how risky a particular asset is compared to the market. So what is the market giving me? And what is this measure in line with the market? Right, we are comparing the asset that you're looking at to the market, and you're getting a measure of the sensitivity in terms of the returns in relation to the market. So beta is that measure, the measure of risk for having invested in the market. All right, so now we have an example here, just highlighting this capital asset pricing model. If you were asked to calculate the required return for this particular asset, here we have a beta for asset Y, which is 1.4, and we have the current risk-free rate of return, which is 5%, and we have a market return, which is 11. So remember, we need that formula, okay? The required rate of return is the risk-free, which we spoke about. Okay, that's like your C value plus the mx. Okay, if this was a straight line, y equals mx plus c. Okay, so we're looking at that straight line. Okay, obviously risk-free, that's the risk-free. Okay, risk-free rate of return. Right, so here the risk-free rate of return was 5%. Okay, the beta was 1.4. The market return was 11. And the risk-free again was 5. So the difference here would give us a premium. Right, so basically we've got 5% plus that risk-free or that risk premium of 8.4, which is 13.4%. So what does that mean? This means if I'm going to invest money in this particular asset, in asset Y, okay, because asset Y has a beta of 1.4, meaning this is higher risk. If this asset is higher risk, you would want a higher return. The market is offering 11%. The risk-free is 5%. So because I'm looking at beta of asset Y as being 1.4, I'm going to require a required rate of 13.4% from this particular asset to justify the decision to invest in this asset. Right, and that's what you're looking at here when you look at the capital asset pricing model. You're looking at these these measures, okay, in terms of what information is available that you can calculate in order to determine the required rate of return for a particular asset. And then once you've done that, you're obviously going to have to make a decision. Right, so the last step is to decide whether this is overvalued or undervalued. Right, so we just worked out the required rate of return. Okay, remember the required rate of return is CAPM. Okay, that's your measure based on the level of risk. CAPM is theory, okay, investment theory, and then you've got the holding period return or the expected return. Remember earlier on, we spoke about measuring the expected return for a particular asset using the table method. Once you've calculated the expected return, if the expected return is less than the required return, that's overvalued. Overvalued means you're going to sell. Okay, that value is overvalued. It's overvalued. In other words, the price is too high. Okay, you'd want to sell that particular asset. If the expected return is greater than the required return, then you have an undervalued asset, and that is a buying opportunity. So in certain questions, they might be asking you about whether you should purchase, buy, or sell a particular asset, and you might have to compare the different returns that are available in the question, either the expected return or the estimated return that's provided or given, or you might have to have calculated it, and then you're going to have to calculate what that is and then compare that to the capital asset pricing model, the CAPM required return. Okay, if you compare the expected return to the required return, that will give you a decision either to buy or to sell, depending on whether the asset is overvalued or undervalued. And that concludes this set of notes for support material 1. I hope all of the content makes sense. If you have any questions, please let me know. The summary is just highlighting the most important points that we've covered in this particular set of notes. We looked at the investment setting, we looked at different asset classes, we spoke about this concept of risk and return. We then looked at how markets are organized and how they function. And then we also looked at developments in investment theory. We looked at valuations, we looked a bit at time value of money, okay, just talking about the different ways that assets can be measured in terms of value. And then we also looked at capital asset pricing model and how we can use investment theory to make decisions on whether assets are overvalued or undervalued. Please try complete some of those additional questions in the resources that you have available.